Hi guys, this side Avinash Gaurav, one of the co-founder and mentor at Finchase. We are providing courses which can help you to learn basic and advanced Excel, financing modeling and valuation at a very affordable cost. We are providing courses through some real life case studies which can help you to learn basic and advanced concept easily related to modeling, valuation, Excel, anything. And also at the same time, it will help you to crack your interviews related to this field. You can visit our website for more details. I will be mentioning the link in the description box for this video. And I will request you all to please like, share, and subscribe our YouTube channel for more such amazing concepts related to financial modeling and valuations. And before we start, so today the topic of discussion is cash waterfall. I would say this concept as an advanced modeling concept because this is something that is required if you want to build the model for project finance, right? Now, first of all, let's try to understand what is this cash waterfall. So, cash waterfall is basically a mechanism in which you are paying the you are paying for the expenses according to its seniority. Now, what is the seniority which I am talking about? So, seniority is something. So, for example, in order to run your business, you are supposed to pay for something. For example, the day-to-day expenses you are supposed to pay for your indirect expenses. Then you are supposed to pay for your interest. You are supposed to pay for your taxes. You are supposed to pay for your working capital. You are supposed to pay for your capex, right? And once you have paid these, then you are supposed to pay for your loans. Now, after paying for the loans, you are supposed to pay for your junior loans and all. So, what happens in real life is that whenever a company approaches to any bank for a loan or to any shareholder for the investment in equity, then there is a financing document that is being prepared among them, and in that financing document you can see the seniority of the payments, like which needs to be paid first and which needs to be paid last. And on the basis of that document and on the basis of those seniority, this cash waterfall mechanism is built, right? But irrespective of any industry, irrespective of any sector, the mechanism, the calculation techniques always remains the same for modeling cash waterfall in your model. Okay, so now in this particular example, we are going to calculate the cash waterfall. We are going to build this mechanism in our model, and the sector which we are considering right now is the solar sector, right? And you can see from the screen the timelines. So it's a quarterly model actually. Here we don't have any construction phase, because it's assumed that construction has already happened in the past. Now it's just the operations phase. So you can't see any labels for constructions. You can only see the labels for financial close and operations, right? Then you have a years corresponding to every quarters. Then you have the period number, which is basically your the number of quarters. Correct. Now let's try to build the mechanism for this cash waterfall, how we are going to build it. So you can start with three different things as a starting point. You can either start with the revenue, you can start with the EBITDA, you can start with the EBIT, or you can start with net income. The only thing which you are supposed to maintain is that you need to take into account which factor you are supposed to include, which factor you are supposed to exclude, right? But as a suggestion, as from the experience, I would always suggest to start it from revenue line. So first of all, we will have a revenue line. Our model is in USD thousands, so the units will be USD thousands. And revenue, I can simply link my revenue to the revenue which I am generating. And in case of solar model, the revenue which I am generating is through electricity generation revenue, right? I can link it to my P&L statement. Now this is my revenue, and my row total will be obviously the sum of these terms. Okay. Now, after revenue, I need to look out for the expenses. What are the expenses which I am supposed to pay? Now, in this particular example, I am only supposed to pay for the O&M costs. There are no other costs associated with it. So the only expenses that is remained is O&M costs, right? Now, I can link this O&M costs with the costs that I have calculated for O&M. Okay, so here you can see like the cash which I am paying for O&M costs. Correct, guys? Okay, and this is the cash which I had paid for my O&M costs. Okay, now after paying for the O&M costs, you are supposed to deduct taxes, whatever taxes you have paid. So taxes, I can link it to the tax which I have calculated here. It's in the tax sheet, so we have calculated our tax here. So currently it's a party number, so I can give it a minus, and I can say okay, so this is my minus number. Okay guys, now you are supposed to calculate the capex. So currently in our model we don't have any capex, so I can simply say this as 0. Correct. Yeah. But if you have capex, then you need to consider capex here. Now, the next thing will be adjustments or change in working capital. Now, we can say this as equals to, we have already calculated the working capital. Now, we are supposed to calculate the change for it. So here is your working capital, which is nothing but your current assets minus current liabilities. And if I am calculating the changes in working capital with as the formula as current period minus previous period, then I need to put a bracket sign and apply a minus sign before the bracket. Because if my working capital is positive, then the change is going to be negative, because working capital positive means that your current assets have increased, and if your assets have increased, that means the it means that the company has incurred a cash out from them, so this is like a negative cash, right? Now once you are done with these adjustments, then you can say okay, so now you can have your cash flow available for debt service. Correct, guys? Yeah. Yeah. Okay. So now this will be your cash flow available for debt service. You can say it as CFATs. Guys, this is a very important term. It's most of the time asked in interviews, and you need to learn this. Like, what is cash flow available for debt service? So, what does this say? This says that once you have paid for your all your mandatory expenses, then whatever is the left, that will be available for your debt service repayment, right? So we can say that cash flow available for debt service will be basically the summation of all these line items. Okay, guys. Okay, now we can make this bold, and we can give it a upper line. Okay, now this is your cash flow available for debt service. Now I talked about priority in the beginning, so the first priority is always to the senior loans, right? So now I can say that senior debt interest which I am supposed to pay. Then I can say senior debt principal repayment. Now you are supposed to pay for your interest and your principal repayment. So interest, senior loan interest, I have already mentioned this in my P&L statement. So I will link it with my P&L statement. And senior debt principal repayment, we already have calculated in our debt sheet. Okay, so here we have senior debt principal payment. It's already negative sign, so I can simply link it from there. Now I can do a row total. Now after this, you can say your cash flow available for junior loan or RCF, right? So once the senior debt lenders are paid, then you have a, if you have a junior loan, then you need to say this as a cash flow available for junior loan, because the next priority will be for junior loan. If you don't have a junior loan, then you can simply say that this is the cash flow available for RCF. Now, since in our model we don't have any junior loan, so we can say this as a cash flow available for RCF. So RCF is basically your revolving credit facility, and it's also, I would say, advanced modeling technique. And if you want to learn these concepts, then I would request to please drop in comments if you want to learn about RCF. I can put in videos for it, or you can join our course in our modules. We have already modeled RCF in our models. Okay, so cash flow available for RCF can be sum of cash CFATs, then the interest which you had paid, and then your senior debt principal repayment. Okay, so now this will be my cash flow available for RCF. Now, once you have cash flow available for RCF, then you can say what is my RCF drawdown. What is my RCF drawdown? What is the RCF interest I have paid? So whenever you are taking out any credit facility, you are using it, you are supposed to pay the interest for it. Then you have a RCF principal repayment. Like if you are, so it's also kind of loan only. So you are supposed to pay the interest and principal on it. So you are supposed to model this. Now RCF drawdown, I can link it from my debt sheet. I have already calculated it there. So here is your RCF drawdown, guys. It only gets activated once you are falling short of cash. So by short of cash, I means that if you have a negative cash in your system, then you can say, okay, so let's withdraw the money from RCF and make it a cash at positive cash, right? Or there are sometimes in real life there will be scenarios where the lender or the equity holders always want to maintain the minimum cash of, let us suppose, 50,000 US dollars, right? Then you can, if you are falling short in cash over any period for, and you are not able to maintain the 50,000 USD cash balance, then you can simply withdraw RCF, right? So in order to maintain for the minimum cash balance, or in order to maintain for the positive cash, we are withdrawing RCF, correct? And again, just to repeat, RCF stands for revolving credit facility. Now I need to link it the RCF interest which I have paid, and RCF interest which I have paid is basically calculated in your debt sheet. Okay, now next we will have RCF principal payment, which we have also calculated in our debt sheet. Here is the RCF principal repayment calculation, guys. Okay, and you will only pay RCF interest and principal once you have the enough cash. And priority will always be to pay for the interest first, then the principal for RCF. And you will only pay the interest with whatever cash you have available, And if you have not available the surplus cash, then you can only pay the part of the interest, and the rest interest you can carry it forward. Correct? So this is RCF principal repayment. Once you have paid for your junior loan or your RCF, then and you don't have any other obligations to pay, then you can say cash flow available for shareholders. See, actually, in every model, the shareholders' priorities always remains at last, right? So yeah, so that's why once I have paid for all my mandatory expenses, then I can say whatever cash is available, that is available for my shareholders, and my cash flow available for shareholders will be cash flow available for RCF, then comma RCF drawdown minus RCF interest paid and minus RCF principal repayment. Okay. So this is my cash flow available for shareholders. For presentation purpose, give it a upper borderline. Okay. Now this you have your cash flow available for shareholders. Now I can say share capital redemption. What does this term mean actually? So share capital redemption is basically, so let us suppose at the beginning of your business, someone has invented 1 million equity value in your company, right? They have invested 1 million as your share capital. Now at the end of the business, we generally assume in real life that at the end of the business, when you have enough cash in your business, then you will start paying out for the share capital that they have invested at the beginning. So this is known as share capital redemption. It's not always present in every models, but in advanced models you will see this share capital redemption, and it's only paid once you have enough cash. So we already have captured this in our model. So again, if you want to learn about this modeling technique, then again you need to you can subscribe to our course and you can learn these concepts from there. So share capital redemption, I can currently link it from my equity sheet. I have already calculated in my equity sheet. So here is the share capital redemption, which I can link it. Okay. Now, this is my share capital redemption. After share capital redemption, I can say now finally my cash flow available for share for dividends, because for shareholders you are supposed to pay dividends. Guys, these are the most realistic and practical approach. So in our courses, we always try to be very practical, and we have already covered very practical aspects, and that's why like it's more realistic actually. You can link you can realize it through the flow of calculation that it's realistic actually. In this way only the real life cases happen. So now you have a cash flow available for dividends. So cash flow available for dividends, I can say it as sum of my cash flow available for shareholders comma my share capital redemption. Correct? Now, this will be my cash flow available for shareholders. Okay. Now, again, make this a bold line because it's kind of heading. So, yeah. So, this will be a cash flow available for dividends. Now, you are supposed to pay for dividends. Now, dividends paid. How much dividends we have paid? Again, guys, to calculate the dividends payout, it's not that simple, which we think generally in our like as a starting point. It's not that simple. There are certain mechanics involved here. So yeah, so dividends paid is generally a complex concept, and if you want to calculate it correctly and according to the real life that is happening in the companies where you will work or you are working, so yeah, it's a really complex thing, but we have covered this in our models. So yeah, if you are subscribing to our course again, then again you can learn these concepts. So dividends paid, I have already calculated in my model, and it's saying as it's an equity seat, and here you can see like I have calculated the dividend, and here is the dividend which I am paying finally. So yeah, but Let's make this as a not bold line. Okay. Then after paying for the dividends, you don't have anything to pay. Then you can say, okay, this is your net cash in the company. Okay. And what will be the net cash, guys? Guys, net cash will be nothing but your cash available for dividends plus your dividends which we have paid. So now this will be your net cash that is available from your business. And then you can say this as a final conclusion line. And guys, remember one thing: whatever net cash you calculate from cash waterfall, it should always match with your cash flow statement that you calculate using the old method, which is basically first you calculate cash flow from operating activities, then cash flow from financing activities, then cash flow from investing activities. So whatever the net cash is there, that should always match with your cash flow waterfall statement. If it is not matching, then you are doing something wrong, right? So always at the starting point, always introduce a check here, like if my cash is matching with my cash flow statement, cash generated through waterfall is matching with my cash flow statement. So guys, please always remember these small things. And if so, this is all regarding cash waterfall, guys. I hope you really enjoyed learning this concept, and I was able to explain it. And again, as a reminder, I would request you all to please like, subscribe, and share our videos so that these concepts can be accessible to more people, as these are some advanced concepts which are generally not covered by many of the institutes. But at Finches, we are covering these. And also, please like, share, and subscribe our YouTube channel. And if you want to take a visit, please do visit our website for more course details. And you can always connect with us. We will be there to help you in this journey. Thank you so much, guys, and stay tuned for more such amazing finance concepts. Thank you so much.